Welcome, everyone. Welcome to another episode of Wealth Talk. The latest update is that Mr. Trump has imposed a 50% tariff, triggering market reactions and several global developments. Initially, we planned to focus mainly on company results this week, as many have already declared earnings. However, in times like these, it's not just about results. We must also examine export dependent sectors and companies to assess their exposure and potential risks. This week, our focus will extend to industries heavily involved in exports and export related activities. In sectors such as textiles, shrimp and prawn exports, solar panels, linen, and allied industries, certain companies, both listed and unlisted, including small scale enterprises, have over 75% exposure to the US market, with some reaching as high as 80-90% based on available data. At this stage, we must evaluate how much further these sectors could be impacted, given the constantly evolving global situation. So, Prasad Garu, how do you see these US dependent export sectors navigating the challenges posed by this steep tariff hike?
The first point to note is that the 50% tariff imposed by Mr. Trump today is no ordinary measure. It is highly extraordinary. However, regardless of how dramatic it seems, the key question is what will be its real impact? To give an analogy, to kill an ant, a light press with your finger is enough. Dropping a 1,000 kilos rock on it doesn't make it more dead. It's overkill. Similarly, we must see whether Trump's action will cause India a loss of 25%, 50%, or something extreme like 500%. Since the possible scale of damage was already anticipated, the Indian equity market did not react with panic. Even after the announcement, the market remained stable, moving only between 0.5% and 1%. This shows that Indian investors and institutions, and even foreign investors, have faith that the impact on India will be limited, maybe even turning out to be beneficial. The belief is clear. Reduced exports to the US will not halt India's growth. To understand this better, total market capitalization of the Indian market is 446 lakh crore. Companies exporting at least 50 crore worth to the US together have a market cap of about 39 lakh crore, less than 9% of the total. Not all of their sales go to the US, only some have high American exposure. Total annual sales of all listed companies in India is 166 lakh crore. Goods exports to the US, excluding services and pharmaceuticals, is 5 lakh crore. That is less than 3% of total turnover. Now let's do the math. If a 25% tariff applies and companies sell only to the US, the impact is 25% of 3%, that is 0.75% loss. In reality, most goods have a global market, so dropping prices by 10% could attract other buyers, reducing the net hit to below 0.5%. Even a 50% tariff would push that to only about 1% loss in profits. The final conclusion is that the economic damage is small and there's no cause for panic. Moreover, self-respect in trade negotiations is essential. Without it, a nation is like a lifeless body. If a boycott of US goods begins, American companies themselves might pressure Trump to reverse policy. If such sentiment spreads globally, the US will be forced to change course. Trump's disruptive moves won't last forever. America cannot sustain them. In markets, blind fear and endless greed are both dangerous. Decisions must be made with understanding, not emotion. The main market adjustments to Trump's actions are already behind us. Recently, U.S. Commerce Secretary Howard Lutnick suggested even imposing tariffs on services, including software. But without Indian software, America would face severe problems. If the U.S. does attempt this, India could respond with digital taxes on companies like Google and Amazon. And if adopted worldwide, such a move could deeply damage the U.S. economy. While we can't yet predict the exact path ahead, one thing is clear. Any difficulties will be short-term, not permanent.
From a purely economic perspective, the recent commentary is that Trump imposed an additional 25% tariff because India is one of the few countries still importing oil from Russia. While the accuracy of this claim is debatable, the rationale is that importing Russian oil indirectly supports Russia in the Russia-Ukraine war, thus triggering this penalty. For the average person, the main point is that India imports about 30% of its oil requirements from Russia. Although this Russian oil is cheaper, local fuel prices have not decreased accordingly. This has caused concern, especially since some companies refine this imported oil and re-export the refined products for profit. The big question people ask is, If Russian oil imports are the reason behind this tariff conflict, why isn't the common man seeing any benefits? Perhaps, Prasad Garu, you could clarify this from a purely economic angle, setting aside political factors. Why does the government take such steps? Is it due to the need for diversification, welfare schemes, tax incentives, or other economic reasons? Or are there additional factors at play?
For an economy to be strong, the government must have adequate resources. If those resources are available but not used wisely for public welfare, infrastructure, and national development, and instead are given away recklessly, such a government is rightfully open to criticism. But supporting the poor should not automatically be labeled as free handouts. If we want to maintain the strength of our human resources, that support is essential. Setting politics aside and focusing purely on economics, many contracting agencies and construction companies say that when they work with the central government, payments are prompt, processes are more transparent, and bribes are minimal. They imply that state governments still often try to exploit contractors, whereas the central government does not. As a result, massive public assets, airports, roads, railways, shipping ports are being created, largely due to reduced corruption at the central level. When some suggest that India should cut interest rates just because other countries have, they overlook an important point. In India, tax compliance is already viewed negatively. From someone paying $10 in tax to someone paying 10 lakh, the question is always, what do I get from the government? People rarely acknowledge how much of the current ease of doing business and access to public sector facilities is the result of sustained government investment. With the government spending heavily on infrastructure, I personally see no fault in that, and I would praise any party that continued this approach. For investors, calling out wrongs and praising rights should not be mistaken for political bias. As for why rates aren't being reduced, the logic is simple. As long as resources are used effectively, there's no cause for concern. Lowering rates would shrink revenue inflows, and many taxpayers would simply find loopholes to avoid paying. GST and oil taxes are major revenue streams. While the center may prefer to collect this revenue directly to ensure it's not wasted by states, states argue they can manage it themselves. For citizens, the only relevant question is, in whose hands is the chance of misuse smaller? Since misuse can't be completely eliminated, funds should go to where it's least likely. The second point, as discussed earlier, is about crude oil imports from Russia. India has significant refining capacity, and those refineries need crude to keep operations and jobs running. From an economic standpoint, it makes sense to source oil from wherever it's cheapest. Unlike some countries, India cannot impose wide-ranging sanctions. Our first duty is to protect Indian interests. This means securing essential commodities at the lowest possible price. So, while not all government actions are perfect, this particular decision is not only 100% justifiable, it is 110% justifiable.
As Prasad Garu mentioned, so far, taxes and tariffs on services have remained off the table. However, recent global headlines, especially from the EU and the US, show rising pressure on pharmaceutical companies to reduce drug prices. American manufacturers, both globally and locally, have received clear directives on this. Our pharmaceutical sector, particularly in Telangana and Hyderabad, is heavily invested in the US market, meeting strict FDA regulations with specialized manufacturing facilities and significant exports. With Trump's threat of tariffs as high as 250%, the key question is, what risks do these developments pose for pharmaceutical companies? Additionally, for companies with limited US exposure that continue to show stable growth and strong fundamentals, do they represent better investment opportunities? Are such options available?
In pharmaceuticals, Trump's stance needs to be viewed from two angles. First, Trump has said that if a pharmaceutical company sells a product in other countries at a low price but charges 5 to 10 times more for the same drug in the US, he will target them with taxes. From a fairness standpoint, most Americans will support this, just as we in India would support our own government doing the same here. For most sectors, people may oppose Trump's trade measures, but in the case of pharmaceuticals, if the goal is to lower medicine prices, it will be popular. For example, a drug priced at $85 in London but $1,200 in the US is bound to cause frustration. These high price gaps exist because companies that develop their own drug can sell it very cheaply in regulated markets like India, but at whatever price the US market allows. Trump's anger is mainly aimed at European made drugs, where the exact same product is sold at vastly different prices between Europe and the US. His stated threat is a 250% tariff, but the media often generalizes this as 250% on pharma, which creates confusion. For India, the likelihood of facing such high tariffs is low because the majority of our exports to the US are generic medicines, serving the masses and keeping healthcare costs down. In the US, insurance companies bear most medical costs, so if tariffs make Indian generics more expensive, these companies would pressure Trump to roll them back. Indian Pharma's cost advantage is well known, and our plants already meet FDA standards. Cutting off supplies would force Americans to buy costlier alternatives, which neither insurers nor patients would welcome. Risk assessment: a heavy 250% tariff on Indian Pharma is very unlikely. A smaller tariff, say 5%, 10%, or 20%, is possible. If an item costs $10, a 20% tariff raises it to $12. Often, 50, 60%, sometimes all, of that increase is passed to consumers, with only a small portion absorbed by manufacturers. Contract research or manufacturing firms might have to take a 1-2% margin cut, but it's unlikely India will bear the full burden. Even if there's some impact, public health considerations will likely prevent extreme actions, making long term damage improbable. However, companies with very high dependence on US exports face higher short-term risk. For example, Granules India exports 94 to 95% of its output to the US, with margins of only 7 to 8%. A 20% tariff split evenly between the company and the consumer could wipe out profits overnight. Here's a list of Indian pharma companies with notable US exposure. Granules India, 94%. Bliss Pharma, 92%. Jubilant Pharma, 83%, Zim Laboratories 82%, Piramal Pharma 82%, Laurus Labs 68%, Natco Pharma 63%, Alembic 60%, IPCA Laboratories 55%, Grand Pharma 48%. My advice is if you hold companies with over 10% US export exposure, exercise caution. Assess whether this is a short-term storm or a long-term threat, but avoid panic. No government will want to provoke a healthcare crisis for long. Even Trump would face political risk if he kills the industry entirely.
At this juncture, many investors holding existing portfolios have often discussed their cash positions. We've reviewed individual holdings, shared views on specific stocks, and given guidance on where to trim and where to add. However, we haven't often looked at the overall journey of the portfolio, its past performance, weaknesses, and the report card concept we've been talking about for some time. In other words, if you give me your portfolio today, I should be able to assign it a score based on various parameters. We've been researching and working towards such an evaluation method. Naturally, this raises a question. With such a portfolio in hand, how do I assess its current performance and then take corrective actions? So, Prasad Garu, how can we evaluate a portfolio based solely on its stock holdings?
A portfolio at its core is simply a collection of stocks you hold. Within it, some stocks may stay on your mind due to personal bias or attachment. But from a true investment perspective, the focus should be, I want my investments to perform well and earn profits. Wishing for all held companies' share prices to rise is beyond our control. It may happen by luck or it may not. However, if you ask any investor, if a company's profits keep growing consistently, will its share price rise? Almost everyone will agree, yes. The reverse, however, is not necessarily true. A rising share price does not guarantee profit growth. The takeaway: hold only companies with steadily growing profits. If you believe you can identify stocks whose prices will rise without profit growth, you're gambling, not investing. Buying on hearsay or because someone else profited rarely results in a balanced, rational portfolio. That's why every rupee you invest should go into good companies. We've given many portfolio suggestions. Around 10% of investors acted on them and continued the journey with us. Most, however, glanced at our reports, set them aside, and forgot. To help such investors, for a limited time, we're introducing a simple portfolio score system. Show us your portfolio and we'll give it a single score. A high score means your portfolio holds quality stocks, you sell at targets, and reinvest wisely, greatly increasing your chances of beating the index. The method is simple. Buy only good stocks. Avoid emotional attachment. Sell at the right time. Reinvest in quality companies. Key point: if your score is above 93%, you have a 90% chance of outperforming the index. Scores below that aren't bad, but your probability of beating the market is lower. Our research, using data from clients and independent investors over 2 years, found that those who kept scores above 93 outperformed others whenever the market rose again, regardless of prior ups or downs. If your score is low and unchanged, results will not improve. But if you replace underperforming stocks, the score jumps, and so do your returns. Our free offer: for the next 1 to 2 months, send us your complete portfolio. We'll give you its score and, if needed, suggest which stocks to sell and which to buy to move closer to a perfect 100. After that, monitor every 3 months, replacing any stock that underperforms or turns weak.
Right then, we'll wrap up for this week. As Prasad Garu mentioned, the complete report we've prepared for this portfolio score, along with all our research behind it, will be discussed in detail next week without fail. Hopefully, the coming week will bring positive developments. If there's no major breaking news and things remain stable, we'll return to our regular programming, analyzing results, reviewing the portfolio score thoroughly, and then moving on to other investment related topics. See you again next week, and thank you for watching.